In this week's update, US inflation picks up and changes the tone of markets. Where to for markets from here? There's a real party going on for some Australian small caps, and the gold sector moves into overdrive. My name's Garry Davis. As always, this is general advice only, and please remember to like and subscribe to the video. All right, let's start with the market perspective because quite a lot has changed in the last week, certainly fundamentally, not so much with the charts and the price action, but plenty to talk about today. So the US index charts have weakened a little bit. However, it's not really enough yet to warrant changing anything significantly. But it's a bit of a cautionary tone that I've got in this video. The aggressive growth stocks and sectors in America are still resilient. In fact, they were the most resilient on Friday to the selling. So that's got to be seen as a positive for sure. Global liquidity is on the rise, and that over the decades has shown a very strong correlation with the S&P performance. When global liquidity is rising, the S&P 500 tends to do quite well. However, the markets have been going up now for more than 5 months since the October lows, and nothing goes in a straight line forever. So there would be inevitably one or two corrections during 2024, and this could well be the start of one, and a retest back towards 4,800, as I covered last week on the S&P, would be pretty normal, really. It would not be abnormal or saying anything different about the long-term direction. Now, if you watch these videos for any length of time, you know that I've been saying that 2024 is shaping up as about as good as it gets. The fundamental data that we've seen in the last week with the CPI coming in a bit hotter is a possible warning flag that things may not be quite as good as I thought a month or two ago. Whether it's just an isolated data point and the trend of disinflation comes back or not, we'll have to wait and see. But certainly there is no requirement to change your overall approach at this stage, but probably just look at things with a bit of a less rosy outlook. Now, the Fed has been saying for quite a long time now that we will be data-driven. And frankly, the inflation data that we got during the week just got significantly worse. It was hotter than expected and does reverse the trend that has been in place for a little while now. So we can't just ignore that. And the bond market voted accordingly. Bond yields shot up. 10-year is back above 4.5. The US dollar jumped. So certainly the fundamentals around the market are giving some cause for just a little bit of caution. Now, having said that, there is very substantial diversity in the US market between different sectors, different industry groups, and different stocks. And if you look at the overall valuations of the market, so a lot of what comes across our desk from mainstream media is just talks about the indices or talks about the valuation of the S&P. And it's next to useless using those as decision tools because they're just far too broad and far too general. You've really got to drill down to the sectors and stocks that you're particularly active in. Now, it's okay to do some speculative investing, stocks that aren't yet profitable, and I guess that has a place in some portfolios. But when you look at the non-speculative side of the market, the companies that are profitable, they really want to have very good fundamentals, very good balance sheets, strong, profitable growth, and be trading at multiples that aren't particularly expensive. Because when we get into a period like this where we may get a bit more of a correction, then those stocks that have been trading on extremely high PE multiples have a tendency to get marked down more heavily than others. So the stocks that you want to be looking at buying or owning at the moment certainly want to be predominantly more to the cheaper value side of things. However, the next few weeks, the next few months will present some wonderfully profitable opportunities, because some of these companies that are just going along beautifully, they're not expensive at the moment, and they will get cheaper, and that will set up a terrific medium-term buying opportunity. So the battle, as I see it, is that the fundamentals are no longer justifying the indices being at these levels. The inflation data that we saw last week really does call into question whether the S&P should be trading at this level. However, the money flows say something different. The money flows are what's important, as you know from these Sunday videos. It's just the most important thing we could be looking at. What is the money actually doing? Because fundamental logic often doesn't translate to what you would naturally think would happen in the market. So the fundamentals not looking so good, but the money flows are still looking okay. So the challenge is to own stocks that are still going to rise, and even more importantly, to have a process of buying and taking profit and protecting profit to take advantage of that, because there's very few people that just buy and hold. So that's the challenge of where the markets sit at the moment. Let's go and look at the American market. The S&P ended up down 1.6% for the week, and a lot of that was done on Friday. All 11 sectors are in the red for the week, but technology was easily the best because it only lost 0.2%. So the best performer, and that is not what you normally expect to see, and it's certainly different from what we've seen in the past, because normally the more aggressive sectors will be sold off. But I guess it just points to the strength of the money flows that are going into artificial intelligence and other areas of technology are holding that sector up. So that was the S&P for the week, where the aggressive growth sectors just remain in charge. And even though the fundamental data would suggest something different, that wasn't the way that it was. Now, the US dollar spiked up above 106, and the yield up to 4.53. So certainly things have changed in bond and currency markets. And that took the VIX up to 17.3 as well, which is an area we haven't been in for quite some time. So let's look at the charts. This is the S&P on a daily chart. You can see on the 4th of April, we had a sharp down session, then immediately turned around and went back up. Not a lot happening. We got a gap down on Wednesday with the CPI data, but the market closed well off the lows. We then got quite a positive day on Thursday, and so it appeared that the market was just completely ignoring the CPI data. But then Friday, we did get a further sell down, which has brought the S&P back to the 50-day moving average. Now, the 4,800 retest that I spoke about last week, which is basically bringing us back to the 2021 highs, is still a little bit of a way down. We've still got another 320 odd points to get down to that level. But if we put a Fibonacci scale on this just to see how that lines up, then you find that it lines up almost precisely with that 4,800 levels. So from a purely technical point of view, it makes sense that we could get a correction which is overdue, and a retrace and a retest of that breakout from 2021. Now let's look internally where the money flows are actually going. The Nasdaq versus the S&P. We've certainly flattened out, but finished the week quite nicely. As you can see, the Nasdaq actually did better than the S&P once that inflation data came out. And that's a bit of a surprise. But there's nothing there in that chart other than, I mean, you could look over here. So this was the peak in technology in November of 2021. And then that went into quite a significant decline. So growth rolled over. And you can see that that's first of all started with a bit of a break of this moving average. We got a rally back to it, and then we fell right away. You could look at this and argue that, is this setting up exactly the same as where we were just here? And that's possible. But at this stage, that would only be a possibility. So it's just something that I'll continue to monitor over the next few weeks. If we look at the NASDAQ itself, though, it really was a fairly mild amount of selling on Friday night on the NASDAQ, and the NASDAQ has just gone sideways now since about the middle of February, so nearly 2 months of just sideways action. So it's too early to say whether this is just consolidation and the next move is to the upside, or whether this is the loss of momentum before the markets roll over. There's just not enough there to indicate either way. As you know, semiconductors, I always watch very closely because they're a very good barometer of sentiment towards the more aggressive sectors. And again, there's nothing negative here either. This is a weekly chart on the S&P. You might remember about 4 or 5 weeks ago, we got a sharp down session in SMH. Didn't follow through. And there's still nothing there, even from Friday night. There's still nothing there. And if we put this on a daily chart, there's nothing really there in the charts that are indicating that we've got anything other than just a temporary loss of momentum. We're still trading around the 20-day moving average, comfortably above the 50-day. So that's where we sit with semiconductors. This is semiconductors versus the S&P, and again, no real change there. We've got no relative deterioration in semiconductors. Looking at the individual sectors, you'll notice that over the last quarter, and particularly over the last couple of weeks, they've all turned down. So XLE on top, communication services, materials, and then technology and finance. So they've all turned down in the last couple of weeks. So let's just take a look at that. So that's how the US indices are looking on a relative basis. But let's go and look, or first of all, I'll just have a quick look at a couple of other charts here. So this is Australia over the last quarter, and information technology was clearly the leader for a long period of time. We got some sharp selling a few weeks ago, but we've steadied again now in absolute and in relative terms as well. And the final one I want to show here, this is a weekly chart of growth versus value in large caps, and this is the low in early 2023 in terms of that ratio, and since then, large cap growth has continued to outperform value stocks, which is an indication of the market really being in a more aggressive mindset and wanting to head higher. And you can see the last week was still very much in favour of growth stocks. That's not what you expect to see if we're having a significant top in the market. So if this does turn out to be a bit of a correction, all the indications at the moment are that it's going to be a pretty mild one. Now, let's go and look at the US sectors individually to see if that can shed any more light on whether the market is rolling over as a whole or not. And it really does depend a lot on what you're looking at. There's quite some significant divergence here. So this is XLK, so a couple of months of basically loss of upward momentum, but equally no downward momentum either. This is communication services, pretty similar. In fact, probably looking even a little bit better. It's still trending to the upside rather than going sideways, and nothing terribly dramatic on Friday night. But then we move on to finance. Now, finance, you can see there was some selling started earlier in the week. Now, US earnings season started on Friday night. Morgan Stanley disappointed, Citigroup and Wells Fargo were okay, but Morgan Stanley certainly disappointed. And you can see that there was a little bit of selling before those quarterly reports came out, and quite significant volumes. The finance sector took a real hit in the last couple of days of last week. So that's definitely a different flavour in that sector. This is industrials, which is a very broad church of industry groups. It's there's a great deal of diversity here, but overall, nothing terribly dramatic happening in the industrial sector. Interestingly, healthcare has really been sold off quite sharply, and you would normally expect healthcare to be more of an indicator of the defensive side of the market, and yet it's been sold off very heavily, particularly on Wednesday, Thursday, and Friday. And look at the volumes that went with that. So there certainly is some selling in the US market, no question, but it's not in the areas that you would normally expect if we're rolling over in some sort of topping formation. Just want to touch on the other one I want to look at is IWM. We got some selling on the week as a whole in IWM. Let's just put it on a daily. Certainly some selling on Friday night, but look, the volumes didn't elevate. We got more volume on Wednesday with the CPI report and the gap down, but there's just nothing here. The fundamentals would suggest that markets should be rolling over with this data, but there's really nothing here that you can hang your hat on and say that the market is really turning quite negative. It's the only real negative sectors in America were healthcare and finance, and that's a little weird. So that's the US market. Let's have a quick look at the currencies. US dollar up strongly on Wednesday and then again on Friday. And if we then go to the Australian dollar, so of course that has implications for commodity prices. And there's the Australian dollar, and we dropped under 64 on Friday. Turning now to the Australian market, 63.97 is where we finished. Our index rose 0.2% across the week, but of course that will disappear on Monday, I would expect. But the strongest part of the Australian market, and this is really encouraging, and this is what I've been talking about now for 2 years, and that is that small caps, well-selected small caps, offer far more opportunity and far more performance than most of the rest of the Australian market. So that's where I've been fishing for the last couple of years, and it's paid off very nicely. So let's go and have a quick look at those indices. So first of all, the ASX 200. Not a lot happened last week. Pretty mild, but that will change come Monday morning. But this is the area of the Australian market that's done really well. The emerging companies index, smaller caps, companies that are emerging from years of the market being disinterested. As you can see, the last highs we had up here were back in 2022, and we had significant disinterest in this area of the market, to put it lightly. The money was definitely flowing into the bigger stocks, but it's now come roaring back, and that index has risen from 1900 to around 2250, which is a very significant move. So that's the sweet spot in the Australian market, and there are plenty of stocks in there that have performed brilliantly well. All right, while I'm here, let's look at gold and silver. We'll start with silver first of all. Silver has now broken out and is looking very robust. This is a weekly chart. So you can see we did get a bit of selling on Friday night, but before that, silver had been looking. There's something suspicious about that chart. I'm not sure that that's necessarily the data is correct there. This is the gold chart on a weekly basis, and hopefully this doesn't look the same on a daily chart. No, it doesn't. So again, very, very strong on gold. We spiked to a high of over 2,400 on gold on Friday night, closed at back down at 23.43. And if we look at that on that's on the that's the US dollar. That is on a daily chart. And if we look at the Australian dollar gold price, you can see we touched actually 37.63 is what Optima is saying, with a close over 3,600. So even for the higher cost gold producers in Australia, this is very, very profitable territory. And it's not really translating through to the share prices of gold stocks, because they seem to have done a reasonably good job of getting their costs under control. So I think costs would appear to have stopped escalating, and yet the Australian dollar gold price continues to escalate rapidly. So that can mean only one thing, and that's that the profits are going up very quickly. And that's just not being reflected in share prices at this point in time. So just wrapping up, on the other point about the Australian market too is that we have seen some resurgence in a few gold stocks, not many, but certainly some. But also critical minerals stocks are starting to look a little bit better. We've seen some moves in some lithium stocks, in a couple of graphite stocks, some rare earth stocks. So there is a little bit of movement in that area in the Australian market. Precious metals, just to summarize, up $13, 23.43 US dollars. There are a number of very positive factors that have been contributing towards that. But of course, the strong US dollar on Friday night took a little bit of gloss off at the finish. And 36.27 is where we finished in Aussie dollars. If we look globally, the metal is lagging on the upside. When the gold price goes up, the gold stocks are not really following, as they should. But when the gold price goes down at all, even on an intraday basis, the gold stocks seem to be getting hit hard. So we're still not seeing the response from gold stocks that you would expect to see. All right, let's move on to other commodities. Copper, pretty steady, around $4.26. Nickel was up just a fraction. And when we look at copper, there are supply issues now that have been in operation for most of this year that are starting to tip the balance in favour of a copper deficit. If you go back only 4 to 6 months, most of the major broking houses were talking about a significant copper surplus in 2024. And now they're starting to flip over and say that there could be a reasonable copper deficit as soon as this year. So that's changing the game a bit for copper, and we are seeing more interest in copper stocks. The swing factor here is China's conversion of the copper concentrate into end user products. That's where the demand has been. China has still been importing very significant amounts of copper, and if the demand is going to be sustained, then obviously that's where it's going to have to happen. Crude oil eased off a little bit, 85.66, and obviously geopolitics playing a huge role in that as well. And news just in this morning before I started recording this is drone and missile attacks on Israel from Iran. So, things are getting pretty dicey in the Middle East. And that can have a very significant impact on, obviously, commodity prices, on equity markets across the board. So the situation there is pretty fluid, and that could change the market outlook quite quickly. Just touching on lithium, just a bit of a perspective about lithium. You really need to understand at a much greater depth what's going on rather than just absorbing the headlines with lithium. It's just not that simple, because it's still quite an immature market. And organisations like Benchmark Minerals, who are probably, one of the most reputable independent observers of the lithium market, and they make the point that less than 50% of the lithium production, most of which is in China, is not actually battery grade. And if the growth of batteries is where the real demand is going to come from, then there's a lot of lithium that's being produced that's actually just not suitable. So we've got an immature market. There's just so much that is either misunderstood or is just straight out unknown at this point in time. So you've really got to take a longer term view of the lithium market and use the money flows, the charts to guide what you do in the lithium market. All right, wrapping it up now. The fundamental picture has deteriorated because we had quite a lengthy period of time where we saw disinflation, inflation coming down and down and down, and now we seem to have reached a point where perhaps inflation is starting to tick back up again. It's mostly in the services area. Goods inflation is still on the way down, so that's a positive. But it's the services area, particularly wages, that is holding those numbers up. Wages and accommodation. So the picture has deteriorated. The market had priced in the fact that the Fed would have 3 or 4 rate cuts, and they would start by June. That would appear to be incredibly unlikely now. It would also appear that 3 rate cuts is probably not terribly likely, given the latest data. And we may now be back to sort of September before they hit. Now, that's not what markets had priced in, and so logically you would expect there should be a readjustment to the downwards direction. And we are seeing that in some sectors, but not in all sectors. So it's a bit of a mixed picture at the moment. Overall, you've got to say that money flows remain positive because the aggressive sectors are still the ones holding up. But I think it's prudent, given 5 months of a rising market, we're overdue for some sort of retracement. So I think some caution is warranted at the moment. And as I said last week, if you want to stay on a roll, if you want to stay doing well in the market, then you don't want to try and get greedy with this market. If you've done very well, then you might just tighten up your stops, trim some of your excessive exposures, and don't worry about what you might be missing out on. It's much better to be thinking about protecting what you've got. So just simply manage risk objectively. Portfolio analysts last week, we looked extensively at gold and silver and a number of my favoured targets. That's it for this week. More information on the website, and there's my email address, and I'll be back with you next Sunday. Cheers.